Students, this is N.K. Thukral from Edupedia World. Students, I have been discussing in the previous sessions on sources of business finance. In the previous session, I had discussed on owner's funds. Today, I will take up the chapter on borrowed funds. Let me tell you the background. What is borrowed capital? Borrowed capital consists of funds borrowed from either individuals or institutions. Borrowed capital can be used in a number of ways. Investors use borrowed capital to increase their potential investment returns. This is also known as leverage, also referred to as a loan capital. So, borrowed funds mostly are for the long term and against charge of assets of the company. Borrowed funds are mostly repaid with interest, meaning the borrower pays a certain percentage of the principal amount to the lender as compensation for borrowing. Most borrowed funds also have a maturity date by which time the borrower must have repaid the loan. Thus, we can say the borrowed funds are the funds raised through loans or borrowings. Now let us see what are the sources of borrowed funds. There are various sources of borrowed funds. Let us take one by one. Number one is debenture and bonds. Number two is loans from financial institutions. Number three is loans from commercial banks. Number fourth is public deposits. Next is trade credit, and next is intercorporate deposits. Let me brief you one by one. Debentures and bonds. What are debentures and bonds? Debenture bonds are an important instrument for raising long-term debt capital. A debenture is a document or a certificate which is issued under the common seal of the company, acknowledging its debt to the holder at given terms and conditions. So this is one of the important source of borrowed funds. Another is loans from financial institutions. The central and state governments have established various financial institutions in the country to provide finance to business organizations. These institutions are also known as development banks, as they aim at promoting industrial development of a country. These institutions also conduct market surveys and provide technical assistance and managerial services to people who run the enterprises. So these are the loans can be taken from the various financial institutions. Next is loans from commercial banks. Banking industry, commercial banks are an important source of raising funds for different purposes as well as for different time periods. Commercial banks is an institution which performs the functions of accepting deposits, granting loans, and making investments with the aim of earning profits, like State Bank of India, Punjab National Bank, Allahabad Bank, Yes Bank in the private industry, ICICI Bank, etc. Next is public deposits. Public deposits are the deposits raised by organizations directly from the public. Under this method, companies inviting public deposits are required to advertise publicly along with its financial position. Financial positions is published in the newspaper on the basis of which the public comes forward to give the deposits to the company against which they get the interest. Next is trade credit. Trade credit is the credit extended by one trader to another for the purchase of goods and services. It's a normal day-to-day activities. This trade credit is applicable in all merchandises. It facilitates the purchase of supplies without immediate payment. It is also known as mercantile credit. Another source of borrowed fund is intercorporate deposits. What is ICD? Intercorporate deposit is an unsecured borrowing by companies from other corporate entities registered under the Companies Act. We will discuss in detail one by one. Let us take first of all debentures and bonds. If a company needs funds for extension and development purpose without increasing its share capital, it can borrow from the general public by issuing certificates for a fixed period of time and at a fixed rate of interest. Such a loan certificate is called a debenture. Debentures are offered to the public for subscription in the same way as for issue of equity shares. Debentures is issued under the common seal of the company, acknowledging the receipt of money. Now let me define what is debenture. According to section 2, subsection 30 of the Companies Act 2013, debentures include debenture stocks, bonds, or any other instrument of a company evidencing a debt, whether constituting a charge on the assets of the company or not. So charge may be created or may not be created. So we can say a debenture is a document or certificate which is issued under the common seal of the company, acknowledging its debts to the holder at a given terms and conditions. The amount of the loan, rate of interest, and the security offered are clearly mentioned by the company on that document. So these are all the important factors you need to write whenever a question is asked on debenture. Means it is a certificate, it is acknowledged as a debt to the holder at the given terms and conditions, and amount of loan, rate of interest, and security offered are clearly mentioned in the document or certificate. Now students, let's go ahead. Let us see what are the features of debentures. Number one feature is borrowed funds. Debenture constitute the borrowed funds of a company. Therefore, debenture holders are termed as creditors of the company. Another feature is periodic interest payment. Debenture holders are paid fixed rate of interest at a specified intervals, say 6 months or 1 year. That is written in the certificate itself. Another is mandatory interest payment. Payment of interest is a legal compulsion on the company. It has to be paid whether profits are earned or not. Irrespective of profit, interest payment has to be made by the company. Another is no voting rights. As debenture holders cannot be treated as members of the company or shareholders, so they do not have any voting rights. They cannot participate in the management of the company. They are simply lenders. Another is redemption of debentures. Debentures have to be redeemed or paid back after the expiry of a fixed period or when the company is in the process of winding up. This is the way the debentures are redeemed. Another feature is charge against assets. Any company is borrowing from the public. They have to charge the assets or they may not sometime. Generally, debentures are secured by a charge on or mortgage of the assets of the company, which can be realized in the event of a default of the company. Public issue of debentures requires that the issue be rated by credit rating agencies like CRISIL on aspects like track record of the company, profitability, debt servicing capacity, credit worthiness, etc. So basis on which the lender gives the money to the company. Now students, let us see what are the types of debentures. There are so many types of debentures and bonds. Number one is secured debenture. You can also call it as a mortgage debenture. This type of debenture is issued by mortgaging an asset, and debenture holders can recover their dues by selling that particular asset in case the company fails to repay the claim of debenture holders. So that's why they are called secured debentures. Another is unsecured debentures. You can say as an ordinary debenture. Such debentures are issued without mortgage any asset, that is, this is unsecured. It is very difficult to raise funds through ordinary debentures nowadays. Another is registered debentures. The debentures in which names of the debenture holders are duly recorded in the register maintained by the company are known as registered debentures. Such debentures can be transferred only by a transfer deed and not by mere delivery. Another is bearer debentures. The debentures which can be transferred by mere delivery are known as bearer debentures. The company does not keep any record of such debenture holders. Interest due is paid on showing coupons attached to the debentures. Another type of debenture is convertible debenture. The debentures which can be converted into equity shares after the expiry of a specified period are known as convertible debentures. Another is non-convertible debentures. A non-convertible debenture is a debenture where there is no option for its conversion into equity shares. Thus, the debenture holders remain debenture holders till maturity. Another is zero interest debentures. The debentures which do not carry any explicit rate of interest are known as zero interest debentures. The difference between the face value of the debenture and its purchase price is the return of the investor. So friends, these were the types of debentures. Now let us see what are the advantages of debentures. Number one advantage is ideal for safe investors. It is preferred by investors who want fixed income at a lesser risk. So there is no risk in this. So that's why they are preferred for safest investors. The investors who wants their money as a safe. Second advantage is no loss of control. Debentures do not dilute the control of equity shareholders on management as they do not carry any voting rights. Another advantage is flexibility. Flexibility means debentures provide financial flexibility as they can be redeemed when the company has surplus funds It minimizes the risk of overcapitalization. Another advantage is economical. Raising finance through debenture is less costly as compared to preference or equity capital, as interest payment on debenture is a tax deductible expense. Another advantage is tax benefits. Interest paid on debentures is allowed as a deduction in computation of taxable income, so this results in tax relief for the company. So this is favorable to the company. Another advantage is trading on equity. Debentures holders are paid fixed rate of interest. After payment of interest, the remaining profits are available to the shareholders. When the earnings of the company increase, the company can take advantage of trading on equity by increasing the dividend rate on equity shares. Now students, let us see what are the limitations of debentures. When the borrowing takes place against debentures, what are the limitations either to the company or to the investor? Number one is permanent burden of interest. The debentures put a permanent obligation on the company to pay interest irrespective of profits. Even when there are losses, even then company needs to pay the interest as it is written in the document and charge against the assets. So there is a greater risk during fluctuating earnings. Another limitation is adverse impact on borrowing capacity. The issue of debentures reduces the capacity of the company to further borrow funds. Large amount of debentures also reduces the credit standing of the company. Another is repayment obligation. The redeemable debentures have to be paid back on the specified date even if the company is facing financial difficulties. So it is a great limitation to the company. Charge on assets. Generally, debentures are issued against security of the assets of the company. In the event of default, the debenture holders may attach the pledged assets. So today we have covered the borrowed funds, out of which debentures and bonds, their features, their advantages, their limitations. The important aspect of debentures nowadays is for the public. That means public issue of debentures requires that the issue be rated by a credit rating agency. This is favorable to the public, like CRISIL, Credit Rating and Information Services of India Limited, on aspects like track record of the company, profitability, debt servicing capacity, credit worthiness, and perceived risk of lending. So this is all for today. Let us wind up today for this chapter. Next time we will see the another source of long-term borrowing. That's all. Thank you. Bye bye. That's all.